The Australian dollar took a hit this week on the worst GDP numbers since 2011, but still managed to recover to trade above 75 cents, 3-week highs. There was little response to the RBA's very much expected decision to keep the cash rate at 1.5% on Tuesday, but as always, the statement was of some interest. The RBA was noticeably more upbeat about commodity prices and the boost to the economy, and also looking at the global inflation outlook, viewed it as far more balanced. The RBA statement on Tuesday also noted that it expected year-over-year GDP growth to slow in the third quarter, but we doubt that it expected such a steep slowdown as we saw. GDP in fact contracted by 0.5% in the third quarter. That's the weakest reading since the global financial crisis and the first contraction since the first quarter of 2011, when the Queensland floods really hampered growth. Westpac was certainly ready for a weak quarter, with our final forecast being for a contraction of 0.2%. But special factors did seem to be in play in the third quarter to make it even worse. In terms of construction, Sydney residents might be surprised to learn that construction activity was actually the biggest drag on growth in the quarter. But there was unusually wet weather in Victoria in particular, which hampered construction in the state. And when we do look at the state-by-state breakdown, we see that New South Wales is outperforming strongly, with the slowdown in mining still taking a toll on Western Australia in particular. The Aussie dollar fell about 0.5 cent after the GDP data, but then stabilised. Its downside is being limited in part by the lack of concern over another RBA rate cut anytime soon. In fact, the RBA doesn't even meet again until February, by which stage it'll have a much clearer idea over whether growth rebounds in the fourth quarter. Pricing for another RBA rate cut at the February meeting is only about 15%. The Aussie dollar also continues to find support from commodity prices, with the price of iron ore rising above $80 a tonne this week to 2-year highs. Coal prices are also very supportive. However, the October trade numbers from the Bureau of Statistics were disappointing, with exports reported to be only up about 1%. This is despite a 20% rise in coal prices in the month. We expect much better numbers on the trade side in coming months, including surpluses before year end. In the week ahead, the key for Australia is the November jobs data. We've been going through a soft patch in terms of employment in Australia for the past few months, so a somewhat better number should be seen in terms of total job creation, although the unemployment rate may not improve much from the 5.6% we saw in October. Internationally, in the week ahead, the focus will of course be on the Federal Reserve policy decision. The markets expect the FOMC to announce an increase in the Fed funds rate to a range of 0.5% to 0.75%. In fact, this is 100% priced into markets, so the attention will mostly be on the accompanying statement from Fed Chair Yellen to discuss the outlook for next year. Overall, we think that Yellen is likely to sound somewhat cautious and that this will be a bit of a setback for the US dollar. So with a softer tone to the US dollar, we think that'll be enough to raise the trading ranges for the Aussie dollar in the week ahead, trading, say, 74 to 76 cents. We'll speak to you next week.